afternoon and welcome to this week's edition of Halftime Talk. I'm delighted to have joining us Andrew Lipow, president of Lipow Oil Associates. Andrew has a long history and experience in the oil markets, many years with Vitol, with Amoco, I think, and others, but now sits in Houston and watches very closely the world of oil move before him. Andrew, thanks for joining us.
Well, Sean, thanks very much for having me.
You can't talk enough at the moment about all things oil. It seems only a few months ago that in the aftermath of COP26, oil was a bad word. Now it's sort of the salvation of the Western world in some regards, and here we are trying to figure out how to get more of this stuff. Andrew, just starting with that point, the idea of start of the second quarter, a lot of the sentiment was shifting back and forward. In this part of the world, it feels like we're dealing with the concerns about demand destruction. In your part of the world, it seems in America, it's a lot of concern about supply shortage. How do you see the market at the moment balanced between those two issues?
Well, what we saw prior to Russia's invasion of the Ukraine was the world economies were reopening and demand for oil was going up. And this was happening at the same time that the oil industry had been starved for investment back in 2020 and 21. We saw oil production, of course, in the United States and Canada drop, but we also saw members of OPEC Plus cut back on their production because the demand simply wasn't there. And as we've moved into 2021 and 2022, what we found is OPEC Plus, by gradually increasing their production quotas, have actually been unable to meet those production targets. And as a result, world oil inventories have been declining. So in the United States, we look at it as, well, where is the additional supply going to come from? And meanwhile, as we've progressed here in February and March of 2022, and oil prices have risen substantially, much of the world is now concerned about demand destruction, especially as the price of diesel has soared relative to the price of crude oil.
Well, if we take that point in terms of supply, I mean, there's a lot of things one might point to in the top 10 or top 5 lists of surprises in the last year. One of them has to be the slow return of US oil production. I mean, I know you guys like to make a buck, and there's a lot of bucks to be made if you're drilling at the moment. Why has US oil production not really capitalized on this moment, or is that a misreading of the situation?
Well, I think it's a perception problem, because back in January of 2020, when oil was $63 a barrel, we were producing a huge amount of oil, record volumes, except the oil industry, the producers weren't making any money. Then, of course, came along the pandemic, and now we've seen, a recovery in prices up to about $90 a barrel or so. And what we've seen is producers have been increasing their capital expenditures. The drilling rig count is going up. Companies like Exxon and Chevron have announced that they're going to increase their Permian Basin oil production by 25% and 10% respectively compared to last year. The perception problem is that the market, or people outside of the oil industry, think that you can turn on and off oil production in the United States, and that it's more like Federal Express overnight delivery to get more oil production, when it's really more like the stagecoach, slow but steady. And in fact, the Energy Information Administration expects that oil production in the United States will increase by 850,000 barrels a day this year, and another 960 next year, bringing us to an all-time production record of 13 million barrels a day.
So that is clearly fairly significant. I mean, if you're looking at that from an OPEC point of view, an OPEC Plus point of view, those are serious additional barrels that OPEC Plus is unable or unwilling, perhaps, but certainly most members are unable. That would put the US back at the world's largest oil producer if they're not there already.
Well, OPEC's concern is they look around the world, they see oil production here in the United States increasing. They're concerned about demand destruction, and they're really reluctant, especially Saudi Arabia, Kuwait, the United Arab Emirates, to increase their oil production by utilizing their spare capacity because they see the volatility in the oil market, and they certainly don't want to overproduce production and have a repeat of what we saw in 2020 when oil prices plummeted.
There's a sense, and you use the analogy of the coach versus the kind of overnight FedEx delivery in the context of new oil supply. The technical challenges is ultimately one thing. Where are we at now, or how is the oil production, new production in the US, caught in the same sort of supply chain challenges as everybody else? The ports are congested, steel is scarce, talent is scarce. What are those sorts of issues doing for those who do want to spend money, who do want to dig more holes in the ground, but simply the supply chain cannot meet that expectation?
Well, I think that's a very good point, because the oil producers are stuck with the supply chain issues as well as the rest of the industry. They're, of course, facing drill pipe shortages. They need to get more fracking sand. They need more truck drivers to deliver all this equipment to the site, as well as the addition of chemicals that they use in oil production. So it's taking them longer to bring on production, while many of the privately owned companies would like to bring that production on today.
If we look at another, obviously, probably the biggest story in the world at the moment, sadly, is the terrible war in the Russian war imposed on the Ukrainian people, and all of the ramifications, the tremors that are coming out from that. And one of them, of course, is Russian oil supply. This is one of the world's biggest oil exporters, certainly a major gas and oil exporter to Europe. But many companies, traders, shippers, bankers have stayed away, or at least Western traders and bankers are hesitant to engage Russian oil now. But yet Russian crude is still making its way to the markets. How do you see that, the mechanics of that, and how is that going to play out, do you think, going forward? Do you subscribe to the IEA thesis that in the second quarter that we've just started, we could see up to 3 million barrels of Russian oil shut in?
Well, we have a variety of things happening here. The swift sanctions on individuals and financial institutions have led the oil industry and other government entities into a de facto ban on Russian oil purchases. Now, having said that, people can still buy and sell Russian oil. We see a lot of Russian oil being significantly discounted versus Brent. Urals crude is selling at a discount of over $30 a barrel. If we look at ESPO crude, which loads out of the Sea of Japan, that's being offered at a $10 a barrel discount to Brent. And of course, we see China and India coming in to take advantage of those low prices. But meanwhile, we have Russian oil companies such as Rosneft, who has interests in German refining capacity, as well as a 49% interest in an Indian oil refinery. They're going to continue to take Russian crude. On the other hand, Lukoil has ownership interests in refining in Italy, Bulgaria, Romania, and the Netherlands. So we should expect that Russian crude oil will continue to flow to those countries. Countries like Hungary, the Czech Republic, the Slovak Republic, they don't have very many alternatives to Russian oil. So we do expect that Russian oil will continue to flow to those countries, but many countries in Europe, such as France, the United Kingdom, Italy, Spain, Portugal, they are reducing their purchases of Russian oil. And here in the United States, of course, after a wind down period that expires later in April, we're not going to see any Russian crude oil or oil products come into the country.
If you take that sort of structural disruption of the market, dislocation of the market, if you were still on the oil trading desk, how difficult would it be to navigate this, where you have this very premium product selling at such a discount in the midst of all this other same product, which is much more expensive. What sort of structural impact does that have in the pure mechanics of trading oil every day?
Well, it's certainly made it difficult for the trading companies to manage their risk and decide what to do given the price volatility of oil going from $90 a barrel up to $130 a barrel. And this is actually causing a liquidity crisis in the oil industry because these trading companies not only need credit to buy the physical cargo of oil, they then need additional credit to handle the margin financing facility. As they hedge and prices rise, they need to come up with the margin requirements for the futures exchanges. So they have this double whammy, if you will, on the credit side. And of course, banks have a limited amount of money that they're willing to expose into the oil market. And certainly this liquidity crisis can be seen in the volumes on the futures exchanges declining substantially.
If you take the other big story, obviously Russia, one of the world's biggest oil exporters, the other one, Saudi Arabia, is caught in its own conflict in Yemen for a number of years, and only in the recent weeks it has basically said, don't look to us to save the day. As long as we're being attacked by Yemen Houthi missiles, we're not going to be able to help out in additional supply. And bingo, what happens? The first ceasefire in the Yemen war for 7 years. What is your thoughts of how that narrative, that story, the potential? Well, now there's peace. Saudi, add some barrels. How do you think this plays out?
Well, I think the Saudis have signaled that they're frankly not going to intervene in the oil markets. They've been reluctant to utilize their spare production capacity. The fact of the matter is they're enjoying these higher oil prices to make up for when prices were low a couple of years ago. And this can support their domestic spending budget as well as investments overseas. We've seen Saudi Arabia has now renewed interest in building another refinery in China, which would be able to monetize Saudi oil production in the future.
Looking at China, the outlook for China into the second quarter, we've had some commentators on our daily show saying that they expect a second year in a row of declining imports of oil into China, essentially the world's biggest market.
Well, I think we see in China, there's concern about the COVID lockdowns in Shanghai spreading to other parts of China, slowing down the domestic economy. In addition, these higher oil prices are having an impact on places like Latin America, Africa, and other places in Southeast Asia. So their spending ability goes down. And of course, that impacts on China's ability to sell consumer goods. And of course, the rising natural gas prices, both in Europe and Asia, have a dampening effect on those economies. So when we see that occurring and the impact on China, of course, it gives OPEC plus pause for what the demand is going to look like going forward. And as a result, it's my opinion that OPEC is going to stick with their pre-agreed to plan of increasing production roughly 400,000 barrels a day over the next 4 or 5 months.
As we look at China, Andrew, the sort of global story of Ukraine impacts every corner of the world, and the position of China vis-a-vis Russia. Obviously, the United States and the European Union have both held independent one-on-one meetings with the Chinese president in recent weeks, highlighting more than anything the division between the West and China. And like we saw in COVID, which was an accelerator of new changes, whether they be remote working or other less consequential things. But ultimately, we went into the Ukraine crisis with the fractures between the US and China, EU and China already embedded. Does this event accelerate those fractures, or could it be, do you think, a moment of healing them, of bringing China closer to the West? How do you see this playing out, and the ramifications for it?
Well, I think it's difficult to predict because China is walking this tightrope where they need Russian energy. They're a big importer of Russian crude oil and natural gas. But on the other hand, they need the European Union and the United States markets to sell their consumer goods. The Chinese philosophy has basically been, we're not going to interfere in some other country's domestic policies. We don't want you to interfere in our domestic policies. And I think the EU and the US wants China to take a stand on what they see happening in the Ukraine from even a moral standpoint. And of course, we do not want to see China providing aid to Russia, whether it's military or other support that could continue the war that's happening in the Ukraine.
What kind of wiggle room or position does President Biden have on these issues? Like geopolitically, would he be expected domestically to stand strong to China, or can he back off? What is his own geopolitical space on these issues?
I think President Biden is able to stand strong against China. We saw President Trump do the same thing that was well received by the American public. There's a sense that China has not been fair with the United States regarding trade and intellectual property. There's also issues regarding the Uyghurs and what's happening there, as well as human rights in Hong Kong. So there's a long list of disagreements between the United States and China. But on the other hand, I think the American public is behind the president and the administration on that issue.
If we just wrap up, coming back to the biggest story in the world, the war in Ukraine and the Western sanctions on Russia, we've seen recently the Russians push back on this issue regarding the pricing, that if you want to buy oil and gas from Russia and other commodities for unfriendly countries, or whatever the definition is, you'll have to pay in rubles. Is that a big deal? Is that going to be a big fracture? How do you see that playing out, indeed, if Russia enforces that rule?
Well, I think from the Russian perspective, what they're doing is trying to support the value of the ruble by requiring purchases in that currency. I think that the Europeans are certainly against that because they say, well, we have a contract to pay you in either euros or dollars, and we simply don't want to participate in that manner. I also think that the Ukraine crisis has exposed a growing rift between oil consumers and oil producers, and they're going to be re-evaluating that relationship. And this is probably just another one of those items that is going to force the Europeans to figure out how to wean themselves out of Russian energy dependency.
I mean, in the short term, obviously, that is very, very difficult. We're seeing even talk these last few days when the apparent surfacing of brutal war crimes in Ukraine, with the sort of murder of innocent people, that the Europeans are being challenged to take a firmer stand on sanctions, and ultimately the sort of the critical piece, and that is the energy exports. Of course, it's sort of a catch-22. You're sanctioning Russia at the same time you're paying them $1 billion every day for energy. Do you think that's sustainable? It's a difficult question, not necessarily for an energy trader, but ultimately for an analysis of the politics of the situation, for the West to continue to buy energy from Russia while these crimes surface more and more?
Well, I think in the short term, Europe really has a limited number of alternatives. And what you're going to see is over the next couple of years, more and more actions to reduce the amount of energy that they're purchasing from Russia. If we look at Germany, who's now fast tracking 2 LNG import facilities, we're going to see more things occur along those lines, except that's about 3 or 4 years away. We'll also see additional development of alternative energy, such as solar and wind, will take more and more of a market share away from fossil fuels, but we might even see the delay in the shutdown of coal or nuclear power plants to produce electricity. So while nothing can happen overnight in Europe, I think there's going to be a significant number of steps that are taken. In fact, I believe Lithuania just announced that they're no longer buying Russian natural gas. The fact that they have to pay in rubles will no longer apply because they're going to be able to import that LNG and have an alternative.
Yeah, it's sort of that gap. Clearly, one would think the structural changes here, like we saw 50 years ago in the aftermath of the OPEC embargo in the 70s, which created the IEA and 90 days of storage and all sorts of other efficiencies in engines and vehicles and so on. The structural changes that will come out of this will probably be quite profound, but they will be slow in delivery. What happens in the gap of this period in which those other solutions are not there yet, that's really where I suppose the volatility in this market is coming from. Andrew, we're going to have to leave it there. It's wonderful to have you on the show this week. Andrew Lipow, president of Lipow Oil Associates, sitting in Houston. Thank you for being on Halftime Talk this week.
Thank you very much, Sean, for having me.